50%. That's the share of Americans who in January 2023 told Gallup they were financially worse off than the year before. And just 4 years ago, in 2019, that exact same poll found the opposite. 50% said they were doing better. Same country, same poll, completely flipped. But here's where it gets strange. Between 2019 and 2022, the Federal Reserve, the institution that literally tracks the financial health of American households, released one of the most comprehensive wealth studies in history. And what it found was stunning. Median household net worth didn't just grow, it surged by 37%, the largest increase since the Federal Reserve started keeping records. The average American household crossed $1 million in net worth for the first time ever. On paper, Americans had never looked wealthier. So the data says Americans have never been richer, and Americans themselves say they've never felt poorer. Both of those things are true at the same time. And that contradiction, that gap between the numbers and the feeling, is one of the most important stories in modern economics. Because hiding inside that gap is the real reason so many people are falling behind, and it has almost nothing to do with what the headlines are telling you. Let's start with what actually happened. When COVID hit in March 2020, the economy didn't just slow down, it went into freefall. In the span of a single month, more than 20 million Americans lost their jobs. 20 million! To put that into perspective, the entire 2008 financial crisis wiped out roughly 8 million jobs, and it did it over 2 years. The pandemic did more than twice that damage in 30 days. The government's response was massive and immediate. Stimulus checks went out. Enhanced unemployment benefits followed. The expanded child tax credit arrived soon after, cutting child poverty nearly in half almost overnight. For a brief moment in 2021, something genuinely remarkable was happening at the lower end of the income spectrum. Poor households were gaining ground faster than they had in decades. But then the relief ended. The stimulus check stopped. The expanded child tax credit expired. And child poverty, which had fallen to the lowest level in modern history, climbed right back up in 2022, almost as if the whole thing had never happened. That's your first clue. The financial progress of the pandemic era wasn't built on a new foundation. A lot of it was time. But there was another force quietly reshaping the economy at the same time. To understand why so many Americans feel left behind today, you have to understand what happened to asset prices. When the Federal Reserve slashed interest rates to near zero and injected trillions of dollars into the financial system, money became cheaper than it had ever been in decades. Borrowing costs collapsed. Investors suddenly had access to enormous amounts of capital, and that capital had to go somewhere. It flowed into stocks. It flowed into real estate. It flowed into technology companies. It flowed into almost every major asset class. The result was one of the fastest asset booms in modern history. For people who already owned assets, this was extraordinary. Their homes became more valuable. Their investment portfolios expanded. Their businesses grew. Wealth generated more wealth. But assets only help the people who own them. If you didn't own stocks, if you didn't own property, if you were living paycheck to paycheck and trying to save for a first home, the boom looked very different. You weren't riding the wave. You were watching the price of the ticket rise faster than you could afford it. And right as those temporary supports disappeared, something else arrived. Inflation. By mid-2022, the United States was dealing with the highest inflation rate in more than 40 years. Groceries, gasoline, rent, healthcare, childcare, the prices of nearly everything people needed rose at the same time. Even though inflation has cooled since then, the damage was already done. Prices today remain dramatically higher than they were before the pandemic. This wasn't a temporary shock. It was a permanent reset of the cost of living. And that's where the story becomes personal. When economists ask whether people are actually better off, they don't just look at income. They look at purchasing power, what your paycheck actually buys. And that's what economists call real wages. And when you look at real wages, the picture becomes much less impressive. Yes, nominal wages increased, the number on the paycheck got bigger, but the cost of living rose even faster, which means your paycheck bought less. You are earning more and affording less at exactly the same time. That's not a feeling. That's arithmetic. But inflation is only part of the story, because even without inflation, there was a deeper structural problem that had already been forming for years. Economists call it a K-shaped recovery. Picture the letter K. One line rises upward, the other falls downward. Two groups of people, one country, completely different economic realities. If you owned assets, stocks, real estate, or a business, the last several years were extraordinary. Home prices surged, stock markets recovered, wealth multiplied. The median American homeowner gained tens of thousands of dollars in home equity almost without doing anything. But you have to own the house for that to matter. If you're a renter, rising home prices don't increase your wealth. They make homeownership harder to reach. And as rents rise alongside property values, more of your income disappears into monthly expenses. Less gets saved, less gets invested, less gets used to build a future. For households already depending primarily on wages, inflation didn't simply slow progress, it reversed it. This is the part the headline numbers often hide. When economists report that household wealth rose dramatically, they're telling the truth. But averages and medians can hide enormous differences underneath. One group became substantially wealthier, another barely moved, and another fell behind, all while living in the same country and reading the same headlines. Then comes debt, because this is where the story gets darker. When your paycheck buys less every year, you only have a few options. You can cut your lifestyle, or you can borrow. Across millions of households, borrowing became the answer. Credit card balances climbed, household debt increased, and then interest rates surged. The Federal Reserve raised rates aggressively to fight inflation, but higher rates don't just affect Wall Street, they affect every American carrying debt. Credit cards became more expensive, car loans became more expensive, mortgages became more expensive. The cost of carrying debt exploded. Now, imagine what that looks like in real life. You're earning more dollars than before, but groceries cost more, rent costs more, insurance costs more, everything costs more. The money left over at the end of the month shrinks. To bridge the gap, you put more expenses on credit. Now, part of your future income belongs to interest payments, money that creates no wealth, money that builds no assets, money that simply disappears. And then there's something even harder to measure: psychology. In the span of just a few years, Americans watched 20 million jobs disappear. They watched the government send money directly into bank accounts. They watched inflation surge. They watched housing prices explode. They watched interest rates jump to levels not seen in years. They watched financial markets swing wildly. That kind of volatility changes how people think. It changes how secure they feel, even if their situation is technically improved on paper. Stability has value, and when stability disappears, people remember, long after the economy says they've recovered. There's also a political dimension. Republicans tend to feel worse about the economy under Democratic presidents. Democrats tend to feel worse under Republican presidents. Part of economic confidence is shaped by politics. But politics alone cannot explain what's happening. Because for millions of households, the strain is real. The data confirms it, even when the headline numbers appear positive. So where does that leave us? Here's the uncomfortable truth. The American economy isn't one economy, it's several economies running side by side, and they operate by different rules depending on where you started. If you entered the last decade owning assets, property, stocks, businesses, the system largely rewarded you. Asset prices climbed, wealth compounded, capital worked on your behalf. If you entered without assets, relying primarily on wages, renting your home, carrying consumer debt, the same forces often worked against you. Inflation arrived before wage growth. Housing became less affordable. And when interest rates rose, borrowing became more expensive. The median net worth of an American household may be at a record high, but median is not universal. And for the millions of Americans who don't show up on the right side of that median, the data and the feeling are pointing in exactly the same direction. They're not confused. They're not irrational. They're accurately describing the reality they're living in. They just happen to be living in the part of the K that nobody wants to talk about. The wealth exists, it's just not theirs. And every year that gap becomes a little harder to close. For decades, Americans were told that hard work was the path to wealth. But the last 20 years have revealed something much more uncomfortable. Income builds your lifestyle. Assets build your wealth. And the gap between those two things may be the defining economic divide of our time. Because two families can earn the same income, work the same hours, live in the same city, and still end up in completely different financial futures. One owns assets, the other doesn't. One gets richer when prices rise, the other gets squeezed by them. And over time, that difference compounds. That's why Americans can be richer on paper and feel poorer in reality. Not because the numbers are lying, but because the numbers are only telling half the story. And maybe the most important question isn't whether the economy is growing, it's who that growth is actually working for. If you enjoyed this video, subscribe to Deep Finance for more documentaries that go beyond the headlines and uncover the forces quietly shaping our money, our economy, and our future. And if this story changed the way you think about wealth, share it with someone who still believes the economy looks the same for everyone. Because the next decade won't be defined by how much people earn, it will be defined by what they own. And understanding that difference may be one of the most important financial decisions you'll ever make.